Good afternoon. On behalf of Singapore Management University, I would like to extend a warm welcome to Chairman of Mapletree Investments, Mr. Edmund Cheng, Chairman of SMU Advisory Board for the Real Estate Program and Group Chief Financial Officer of Mapletree Investment, Ms. Wendy Koh, Group Chief Corporate Officer of Mapletree Investments, Mr. Wan Hong Wing, SMU Dean, Lee Kong Chian School of Business, Professor Bert de Rick, members of the SMU Advisory Board for the Real Estate Program, distinguished guests, ladies and gentlemen. Thank you very much for taking the time to join us at the third Mapletree Real Estate Forum for SMU. My name is Donovan Teo, and I am delighted to be your MC this afternoon. A short introduction about myself. I'm currently in the third year of study in a Bachelor of Business Management program, specializing in Finance Real Estate track and Strategic Management at the Singapore Management University. Before we begin this event, I would like to highlight some key safe management measures for our guests on site. Please maintain at least 1 meter safe distancing between individual attendees. Do keep your mask on throughout the event, and you may remove your mask only when drinking. Now, to our guests tuning in virtually, we all hope that you are keeping safe, and welcome to the Mapletree Real Estate Forum. Let us now invite Ms. Koh to deliver her opening remarks. Ms. Koh, please.
Professor Bert de Rick, Dean of SMU Lee Kong Chian School of Business. Mr. Edmund Cheng, Chairman of Mapletree Investments. Members of the SMU Advisory Board for Mapletree Real Estate Program. Panelists of the third Mapletree Real Estate Forum. Distinguished guests, ladies and gentlemen. A very good afternoon to all of you here and those online. Thank you for joining us at the third Mapletree Real Estate Forum. As you may know, the annual forum is part of the Mapletree Real Estate Program at SMU that was first launched in 2018. The forum aims to provide a platform that encourages private, public, academic discourse on current real estate topics and trends. It is heartening to hear that over the past 3 years, more than 700 participants have benefited from the Mapletree Real Estate Forum. Every year, we see active participation from audience with some interesting and thought-provoking questions. We are very encouraged to see these constructive discussions take place, fulfilling the objective of the Mapletree Real Estate Program. Today, our panelists will be discussing about the suitability of a special purpose acquisition company, also known as SPAC, listing for a real estate company. SPAC is not new and has been around for many years. However, it is one of the rising trends across the world in recent years. I hope, like me, you are eager to hear about this from our panelists from a diverse background comprising real estate, banking, finance, and law. Before I hand over the time to our moderator, Professor Melvin Teo, Deputy Dean of Faculty and Research at SMU, I would like to say thank you to our panelists, Mr. Tan, Ms. Lock, and Mr. Thana, for taking time out of your busy schedule to join us today. I would also like to express my appreciation to SMU for all the hard work and dedication put into developing and strengthening the Mapletree Real Estate Program. I wish you all a fruitful and constructive discussion ahead.
Thank you, Ms. Koh. As most of you may know, special purpose acquisition company listing is one of the rising trends across the world. How relevant is SPAC in the real estate sector? What should real estate investors look out for when investing in SPAC? Let's find out more from our panelists that comes from a diverse backgrounds comprising of real estate, banking, finance, and law. May I now invite our moderator, Professor Melvin Teo, Deputy Dean of Faculty and Research of the Singapore Management University, along with our panelist and moderator, to come on stage. Mr. Ronald Tan, Vice President, Equity Capital Market, Global Sales and Origination of SGX, Ms. Lock Yin Mei, Partner at Allen and Overy, Mr. Indran Thana, Managing Director, Global Banking Head of Southeast Asia Consumer, Healthcare and Real Estate of UBS. Over to you, Professor Teo.
Thank you. Good afternoon, ladies and gentlemen. My name is Melvin Teo, and I'm the Deputy Dean for Faculty and Research at Lee Kong Chian School of Business. Today, we have a very exciting program for you, and I'm very excited to moderate this panel on SPACs. To my left is a very distinguished panel who will tell you everything you want to know but was afraid to ask about SPACs and discuss their relevance for the real estate industry. On my left, we have Ronald Tan, Vice President of Equity Capital Markets, Global Sales and Origination at SGX. To his left is Mr. Indran Thana, Managing Director, Global Banking, Head of Southeast Asia, Consumer, Healthcare and Real Estate at UBS. And to his left is Ms. Lock Yin Mei, Partner at Allen and Overy. So can we do a nice little round of introductions?
Sure.
Starting with Ronald.
Thank you, Prof. Melvin, and thank you, SMU, as well as Mapletree, for organizing this event and for inviting us. I think just a quick introduction about myself. My name is Ronald. Unfortunately, I'm not a graduate of SMU, so I'm actually a graduate of NUS Business School myself. That said, I've been with the exchange.
You can leave now.
Okay. We are inclusive. But anyway, a little bit about myself. I've been with the exchange for almost, I would say, over 12 years now. Unfortunately, I was a little bit shy of when the REIT market first listed a few years, but I've been actually taking care of the REIT listings for the exchange for almost 12 years. And of course, currently right now on the equity capital markets where we meet with issuers to list with us, I also take care of the consumer space for that particular sector. And of course, you know, SPACs, definitely today's topic is a very interesting, innovative product. Thank you.
Thanks for having us. My name is Indran. I've been with UBS now for the better part of a decade. The bulk of that time I've spent in real estate in Southeast Asia, which is, at least to me, one of the most interesting parts of the job, just the diversity of this part of the world. More recently, I've taken on roles in consumer and healthcare as well. SPACs, I'm going to be absolutely candid with everyone. I'm an accidental entrant. It was interesting about a year and a half ago. We got involved in it, and it remains interesting. So that's sort of my background.
Hi, I'm Yin Mei, partner at Allen and Overy. The reason I'm here is because I've been involved in the first few SPACs that are listing in Singapore. I've walked the journey with the exchange and the regulators in trying to come up with the rules, rewriting some of the, sort of more entrenched provisions to suit SPACs. Fortunately for me, also, I've been involved in real estate transactions. So today's seminar hopefully brings the best of both worlds to the discussion.
Thank you, Yin Mei. So let's talk about SPACs, right? So as Wendy has mentioned, SPACs have taken the world by storm. So while they have been around since the 1990s, they've really started getting traction since 2020. So in 2020, SPACs alone have raised $83 billion US. And over the last 2 years, there have been 600 SPACs launched in the US. Some of the more notable names in the US to go public through SPACs include Virgin Galactic, Richard Branson's spaceflight company, Nikola Corporation, otherwise affectionately known as the Tesla of trucking, and there is Open Door Technologies, a digital platform for residential real estate. And also, let's not forget Grab, the Singapore-based ride-hailing and food delivery app, which was also listed on the NASDAQ via a SPAC. So in Singapore, the first two SPACs are being listed as we speak, right? The first is by Temasek's Vertex Venture Holdings, which just started trading at 2 p.m. today. super fortuitous. And the second by Ticker How Capital's Pegasus Asia is, according to Ronald, supposed to be trading tomorrow. So the demand for Vertex, the Vertex SPAC has been so strong that it was 36 times oversubscribed. So these are indeed exciting times for local investors who are curious about SPACs. Therefore, I think that it is super fortuitous that we are discussing this topic today. So my first question for the panel is, what are SPACs and how do they differ from traditional IPOs? Maybe Ronald, you can have a stab at this first.
Sure. I think conceptually a SPAC is basically a cash pool company, right? At IPO, you list a company with cash, as well as there's a management team that is there. Where it differentiates from a typical IPO is this starting point where they list a SPAC with the cash and the management team. The management team then goes for the prowl or the hunt for a suitable IPO candidate, for a suitable de-spac target, as they call it. Now, with that, they upfront negotiate with the potential sponsors of these companies whether or not they would like to be de-spac or merged with them. Now, the advantage of this process clearly is that the capital is at hand. They have with them a group of investors that are looking for a target that can be acquired. And so it gives certain level of certainty to the potential de-spac target or the company that wants to be listed. It gives certainty a little bit more in terms of where are the investors, what are potential demand pools that there will be. Now, that's the concept of a SPAC. Now, obviously, around that is that a SPAC also does offer something else for investors who invest at the SPAC IPO. Besides getting units in that particular SPAC, they are also being offered warrants, right? Which potentially give them the upside if the SPAC acquires a very promising company, and then they could exercise the warrants and basically enjoy the upside. Now, a typical IPO is just straightforward. A company says, I think I'm ready. I would prepare myself. I'll look for a banker like Indran, a lawyer like Yin Mei, get myself ready, and I'll just go straight up, market ourselves in a book built to investors, and I IPO. Straight, simple IPO. Right? So that's the differentiation where the SPAC takes a step before that, gets a pool of cash, backs a credible sponsor who is very good in spotting, in acquiring companies, and then he goes for the prowl and looks for a target, and then the target agrees to be merged, and there you get the company being listed. Different routes, but the end goal is to be finally listed.
Thank you for the very nice summary of what a SPAC is. Anything else to add, Indran?
I think theoretically what a SPAC allows you to do, it allows you to match the right type of capital with companies at perhaps an earlier stage of their growth cycle. Because the merger process allows you to share, the normal convention in the world is the merger process allows you to be much more diligent about what work you're doing around the growth prospects of that company. Right now, generally what happens is during that phase, private equity and venture capital tend to be the ones that access that piece of the growth. And there is this virtuous cycle of up rounds that they keep doing, and traditional investors in the public markets get the back end of that through the IPO, where what the SPAC in a perfect sense allows you to do is perhaps cut some of that away. Does that happen in practice? I think you really have to be careful. But I think that's what the beauty of the structure is, that the application is a separate matter.
So one of the advantages of the SPAC is that it allows people to take advantage of the opportunities that were only privy to PE and VC funds potentially in the past.
I think that's what it's best to, because you get to curate investors, right? At the back end, you get to choose the type of investors that will put money, long-term money, not next financial cycle money, into companies with perhaps growth that keeps profitability down for a while, but are very clear later on, and a sponsor in the middle who, again, theoretically, knows what he's doing, can assess that, and then go and market it to those investors, giving them comfort that somebody who knows what they're doing in a slightly more opaque scenario is giving them the comfort to go and put their money backing a company with a very clear sense of what I'm buying.
Yeah, I mean, that's a great point from Indran. I think The extension of the benefit of a SPAC is it allows investors to participate in a public listed vehicle at a T-1 to listing phase, right? What is typically in the private equity space, now we're bringing it a little bit forward to the public capital markets, allowing investors to participate with good sponsors, credible sponsors at a T-1 to listing. And so the upside of potentially it when it goes for the de-SPAC or the merger is now in the hands of investors, what was previously very, very private equity space.
Right.
So that's one of the benefits. Obviously, with benefits come risks.
Sure.
And I know
And we
you
can
know,
talk
we'll
about
talk
that
about that
later
later
on,
on. Yeah.
Yeah. So, Yin Mei, you have worked with SPACs from a legal perspective. So, how do you feel? What are the differences between SPACs and IPOs from a legal standpoint?
So primarily from the de-SPAC target's perspective, right? The de-SPAC allows them to achieve a public listing without the market volatility, right? So if they went for an IPO, they would be subject to sort of pricing pressures, book building, and they may not get out. The de-SPAC route to an IPO through merger with a SPAC allows the target or the de-SPAC company to price in, lock in their price, and remove that volatility in theory from the book building exercise. And then as Ron and Indran have said, the reason they can do that is because, PIPE investors have come in, assuming, giving sort of credibility to the valuations, and then achieving what the de-SPAC target aims in terms of a valuation, removing, the market volatility. So that, is the key reason why a de-SPAC target would do it this way, as opposed to a direct IPO.
Yeah, so the advantages of SPAC is that it sort of gives the target an expressway to an IPO, right? As opposed to...
I think it's not quite as simple as an expressway to an IPO.
Okay.
I think it gives the target the ability to assess his outcome, as opposed to relying on a bunch of shady bankers like me to promise an outcome and then perhaps not deliver it at the back end. Right? It gives them that all of this is theoretical because human nature is such that there'll be different outcomes, but it gives them that certainty that I'm going to sit down with a guy that knows my business. I can discuss what the outcomes are privately and get that certainty before I go put my name out there. Like WeWork is a good example of that, right? They went off and sort of things didn't go their way, shall we say.
Because many things can happen during the book building process, right?
Correct.
It takes a long time to do that.
Correct. And from an investor perspective, during a book building process, I have to make a decision in 40 minutes of speaking to a management team. And then I have to make a choice. I'm not saying every investor is the brightest spark in the world, but it's still a hard thing to do. So there are advantages. I know we're going to get into the risks of SPACs, and
yes, of course,
the data shows a view, and that view is right. But there are advantages to it as well, I would say.
Yeah.
Ronald?
Yeah, I was just going to say that when we say expressway, I would rather say it's another route to get there, because from a regulatory perspective, and I have to say that being SGX, is the process to de-SPAC a target is no different from an IPO. So the regulatory rules, the due diligence expectation from the regulatory side of SGX as well as MAS is exactly the same. So there is no arbitrage. What it gives certainty, like Indran has mentioned, is the investor, right? What sort of valuation? Am I potentially going to get the right investors? I get to discuss that before I agree to a de-SPAC merger.
Yeah, and as we all know, the markets prefer more certainty to less certainty, right? Yeah. So let's move on and talk about, I think we have touched on some of these issues already, but from the de-SPAC target standpoint, what are the key benefits of listing via a SPAC versus the traditional route? You mentioned that the due diligence process is the same, but obviously one of the downsides of doing it via SPAC is that there's a very compressed timeline, right? So you need to get everything done very quickly. But obviously, as Indran mentioned already, the SPAC is beneficial for several reasons. So can we elaborate more on what are the benefits to the targets?
So I think some of the reasons that Indran has mentioned just now in terms of how they negotiate with their investors and with a very knowledgeable sponsor, I'll just put it in a very plain, simple example, hypothetical example, right? Assuming today Elon Musk, this is an assumption, says, I'm going to do a EV SPAC, right? I think any EV target in the world today, if Elon Musk said, okay, I think I like your business, I love it. Now, you have the option of going IPOing, or you have the option of de-spacking with Elon Musk. Guess where, perhaps the audience, who will you choose in the end? Elon Musk SPAC versus a traditional IPO. I think the chances are most people would go down the SPAC route. Now, why would they do that? Because you're assuming that Elon Musk really understands EV, knows the road, and he says, look, if you de-SPAC with me, what I am going to promise you is my network, right? Because after all, he's going to get some promo shares. And therefore, the benefit that accrues to the potential target goes beyond a typical IPO. Now you have an advocate, you have an expert who has his network, who has his credentials that is saying, I think you're suitable, I think that's the valuation, and so it gives you a lot more certainty and benefits that you typically may not get in a traditional IPO.
So there's a benefit of the branding, a benefit of merging with a SPAC with a reputable sponsor.
Yes.
Yeah. Indran?
Look, I think we've covered it already, but I think the other thing is it probably distracts a management team less of a going concern. I have a sponsor group that's going to help me figure out this process. It's going to help me negotiate with investors. It's helped me to find a price that or offer me a price that I'll just take. I don't have to dedicate resources that should be focused on actually doing their jobs with this ridiculous capital markets stuff that they're not really supposed to be doing. I think that's another probable advantage. But it's mainly those two things, I think.
Okay.
Yeah, realistically.
The ability to stay focused on business as opposed to dealing with all the issues surrounding the book building process and whatnot.
Yeah, and maybe the point I brought up earlier, where in theory, getting that suite of investors that really are bought into the story I'm telling, because in most of the world, the SPAC markets allow you to go out with projections and be a little bit earlier stage in your growth.
Yes.
And ideally, what I go and find you is a set of investors that agree with that. Right? I don't go to a typical IPO process and get a bunch of investors are hoping for day one pop and then exit stage left immediately after and create all kinds of problems after. Yeah.
Sure. Okay. Yin Mei?
Yeah. So I mean, sort of saying it another way, I mean, the de-SPAC target, it would benefit a de-SPAC target whose valuation is a bit harder to nail down, right? So if you're an earlier stage growth company, you would look at this route as opposed to where the target, probably has a very efficient market price out there already. A de-SPAC route probably isn't the way to go. Yeah.
Okay, so that's how to summarize some of the three benefits of listing through a SPAC for companies is the branding effect of a big name sponsor, the lower distraction because you already have a pool of capital ready to deploy, as well as the targets is quite useful for targets whose valuations are harder to pin down, right? Targets who do not have like a steady stream of income or earnings yet. So why are they so hot about SPACs, at least in 2020 and at least in Singapore right now? Why do investors subscribe to SPACs? Or what kind of investors are SPACs good for? Indran? Sounds like you have something to say.
No, Ron looked at me and I got worried. Look, at a SPAC IPO, it's really, if you think about it from an institutional investor perspective and where rates are today, it's not a particularly high opportunity cost to put money in a cash box with the option for redemption if I don't agree. If I'm a retail investor, in most of the world, retail investors can't participate in SPACs. Singapore, they can. If I'm a retail investor and we are looking at an IPO of the next hottest company come to market, generally speaking, the guy that's getting the least amount of allocation in one of those processes is the retail investor.
Yeah.
In a SPAC scenario, I get to buy that at the onset, I get to buy that in the market, take full optionality, I buy a ticket to the ball, basically, for the potential that I participate in whatever great idea Elon Musk's EV company acquisition is going to be.
Sure.
And if I don't like it, I say, give me my money back, and no harm, no foul. So from an investor perspective, if investors have to take responsibility for what they buy, right? You can't complain at the back end when you went along with the process, you agreed to a stupid acquisition and it all blew up after. You can't complain, because generally speaking, you should know what you're getting into. But the optionality that you buy with a SPAC is you get to get your money back if you disagree with what they're doing.
But the issue with the SPAC is that, I mean, if more than 50% of the investors say yes, you have to go along with it, right?
No, I can redeem my shares.
You can redeem it. Okay.
I get my $10 back or $5 back. If the rest of the world wants to do it, go forth and prosper.
And in the world where rates are low, the opportunity costs are not that high.
No.
Yeah, I mean, to answer your question as to why is it hot with investors, I think investors are buying into hope through a SPAC, right? And hope that is not built on castle, on air, but it is hope that is built on the credentials of the sponsor group. So there is substance to this. They are hoping that through the credentials of the sponsor, the same sponsor will be able to bring to them a great target. So as Indran rightly pointed out, if I'm an investor, I put in $5 in Singapore's case, it's, well, the rules requires at least 90% of the capital is being escrowed in Vertex that just listed, 100% is put in escrow, it's earning interest to try to fund the expenses. And look, if it doesn't succeed, I have the optionality either to sell it in the secondary market, take back my cash, or even if the vote goes through, I still have the right to redeem back my cash. So there is some downside protection in this, but yet I get the promise of a potential upside. I still hold on to the warrant that was given to me, and potentially, what if he buys into a really good company that, you know, I'm glad I came in right from the very beginning. So what makes it attractive to investors, I think, is the promise of a potential hopeful next unicorn, decacorn, whichever corns you want to talk about, that I can be part of.
Right.
And at the same time, there is quite a significant downside protection.
So it's great for investors to want exposure to potential unicorns out there.
Yeah.
And certainly you want to go with a SPAC that's sponsored by Elon Musk and not one sponsored by Shaquille O'Neal. There's actually one by Shaquille O'Neal, I heard. Yin Mei, any other thoughts?
Yeah, and I was also going to say, and I'm not sure that Ron and Indran would agree with me, I think some investors may look at the escrow account as having upside in terms of a return more than their base capital, right? There's a risk that this may turn into a yield play because the escrow account is overfunded by the sponsors, right? So if you imagine that the sponsors cannot redeem their shares, they've put in more money than their at-risk capital, they've put that extra money into the escrow account, they can't redeem at the business combination, but retail investors can or other investors can. And they do redeem, they're actually getting more than their base capital on redemption. So, there is, in some quarters, some investors actually look at that margin and make their decisions about whether they want to invest in that SPAC.
What is the margin like? How much more than their base capital can they redeem? I know it's path dependent, but can you give us some estimates?
I mean, the investors have been talking to the bankers and Ron, what?
So the typical overfunding in the US, in terms of SPAC terms at the moment, 1% to 2% above the base. So you're looking at yield payouts of something like 3%.
Okay.
That's sort of where the market sort of flowed at the back end of last year.
1% to 3%, let's say.
Yeah, about 3%.
So relative to the Fed funds rate, that's pretty high, but relative to what the market is doing, it's not that great.
Correct, but it's option value. Like if I have a bunch of cash sitting around doing nothing, take a punt on a good name. The problem in the US is it sort of the pendulum swung really far to the other end, right? When Shaq is doing a SPAC and giving you investment advice, perhaps it's time to revisit what's going on. But that's banks have marketed it as a yield stock, like a yield play, in some sense, yeah.
Although we're trying not to do that here, since we have a very good REIT market.
Yeah.
Thanks to people like this person over here, I'm guessing. But you guys have talked about the good stuff about SPACs, but you have also alluded to something known as a promote, right? So SPACs have been, and some issues with SPACs in the US. So SPACs have been somewhat controversial due to issues like dilution and incentive alignment. maybe there are concerns that the sponsor might get really angsty close to the deadline and start to acquire any target that they can. So what are some of the pitfalls and risks that investors should be mindful of when subscribing to or investing in SPACs? Ronald?
I think that the set of rules that have come out are fairly comprehensive, right? For example, the maximum promo dilution for the sponsor, there is a cap, right? And so basically 50% is the cap. And then at the same time, the vote for a business combination basically has to be, mainly the independent shareholders that has to give that opinion. So there are a lot of safeguards around this to ensure that you don't have a sponsor who's desperate to redeem back his sponsor equity at risk and try to just stuff a lemon into the de-spac target, right? So therefore, I think when we go in, when an investor goes in, first be mindful of what are your rights, right? That is protected. Obviously, you need to look at what is the background of the sponsor, what sort of support are they providing apart from the minimum, sponsor risk, sponsor equity. Is there any other feature that they're looking at? What is their track record? But as I said, the way this product has been created, at the end of the day, if you don't agree with it, either sell in the secondary or you can choose to redeem. So there's that level of protection, right, that is accorded. That said, I'm sure there are sponsors out there that might be hard-pressed, but again, the system will run itself through. You have the right to vote. It is going to be to the votes of shareholders, and you could always vote it down. Yeah.
Again, it comes back to finding a sponsor that has a strong brand name and a strong network. Yeah. Indran?
No, I agree with that. I think the promote and those mechanisms are probably less what I worry about. I worry about more the deadline and how many. Like in today's world, I worry about how many SPACs there are in the world, and everyone's got 2 years to do something to get rich.
Extendable by 12, potentially.
Extendable by 12, yeah. But give or take. And those deadlines are shrinking as well in the US. If you look at the most recent data, we're talking 16 months to 18 months. That's sort of what the commitments are being made to get deals done. So it really, really comes down to, are the people I'm giving my money to credible? Do they have domain expertise? What is the governance structure? Can I hold them to that governance structure? Will they do right by me? Have they done that in the past, like in their past lives? Right. And you have a variety of folks. You have got a broad suite of folks that have come out with SPACs, right?
Yeah.
You will find SPACs with sponsors that fit that criteria, and you will find SPACs with sponsors that don't fit that criteria. And the performance will, and the consequences will be what they are for each bucket, but I suspect the first bucket is going to do better. Really, it comes down to the same simple investment advice you would give to anyone.
So typically the sponsors for SPACs are either business executives with lots of experience, PE or VC shops, yep. Or even celebrities, right?
Well, I like to think of it as, yes, that's right, yeah. But I'm not sure celebrity, like if I'm as Indran, I've done this for a while, nobody's going to give me $150 million to raise a SPAC. That's just not going to happen. If I happen to know Shaq really well, they'll give me the money. You know what I mean?
Yes.
Like,
yeah.
So the celebrity part I worry about.
Yeah.
I really like to think about it as, are the people behind it properly knowledgeable about the thing they're doing, and start from there. PE, private equity and venture capital firms are short-term capital, right? So going back to your point around incentives, they'll want to exit at some point as well. Perhaps a scientist that's building EVs somewhere, that has done that through his whole career, who knows that technology really well, that's a guy that may not necessarily want to exit immediately. He's already got all his money. This is an interesting thing. So there's many ways to think about this. I'll be slightly skeptical with the celebrity piece.
Okay, so incentives, credibility, domain expertise.
Yeah.
Yin Mei?
Yeah, I think where we are now, I think given that the first two are out of the door, or rather the second will be out of the door by tomorrow, I think what the focus will be on is the de-spac target. And that worries, I think, the industry, right?
Yes.
That people are hopeful, but also, if you look at the region, the specs are expected to find de-spac targets in the region. So the question is, what is the quality of the de-spac target that is going to come to market? Will investors understand it? Will that de-spac target get the valuation? If you look at the US, I mean, given that we're talking about the suitability of property companies doing SPACs, there was a SPAC called Property Acquisition Corporation, right, backed by real estate investors. They eventually de-SPACed into Future Faraday, which is an EV company, right? I mean, it took off. The question is whether you could do that, right? You have the domain expertise in X, but you're going to de-SPAC into Y because that's trending, that's fashionable,
selling, right?
that gets you, that's the available de-SPAC target. So that's the big question mark that we don't know at this stage, the de-SPAC target. We know who our sponsors are. They're all very good. Exchange has done a very good job sifting through, making sure that the right sponsors come to the market. The question is the next stage.
Right. In the ideal world, the sponsors know that this is a repeated game. They would rather stick to their mandate, but given the supply of possible de-SPAC targets, that might be challenging at some point.
Yeah, I think that's a great follow-on point on de-SPAC targets, right? The other potential hit spot, I mean, we talk about whether the dilution of the sponsors is a concern. What if they stuff lemons into the de-SPAC target? I think apart from potentially taking less than ideal candidates for the de-SPAC target, the other concern to look at is what sort of due diligence, what sort of valuations are the de-SPAC targets promising, right? So I think we've learned from the experiences in the US where forecasts were, well, not quite fully audited or justified in some sense. It was, without any real strong diligence around it. So I think if you look at where the frameworks are today, whether it's us to a certain extent, a lesser extent in Hong Kong, there is a rigor around, you want to put a forecast, which is why we said you want to come out and de-SPAC, the IPO rules and expectation is going to be the same. So by putting focus and making sure equal standards apply, that's how you avoid, the potential misvaluations, the potential over-promise of something that is, a bit too good to be true, and ensure that everybody have their feet grounded towards the floor and say, this is potentially what we think our business growth is like, and therefore the valuations will follow that. So I think that's where the test, like Yin Mei rightly pointed out, is going to happen in the coming months for this current batch of SPACs. How are they going to de-SPAC? What sort of rigor, what sort of diligence, what sort of valuations are we going to put on it? But my sense is that given the emphasis of the framework and reinforcing the need for accountability and the proper diligence, exactly like an IPO, I think we will have a different episode in Singapore, right? And that it would be rightly valued rather than overpromised. That's our hope. Yeah.
Okay, let's hope that indeed that our experience will be very different from the ones in the US, at least after the de-SPACs are done. Yeah. Yes, so SPACs have been hot for a lot of reasons, but they've been typically used by sponsors, as you guys have mentioned, targeting companies that are in high growth areas, right? Where earnings are expected to grow, but maybe they are not that great right now. So industries, areas like technology and biotech. So how relevant are SPACs for the listing of real estate companies?
So I think, look, SPACs as a product is a product, right? It is sector agnostic. And obviously there will be some sectors with certain characteristics that are most suited or will benefit the most of doing a SPAC IPO. So I think that's the first point we wanted to say, is that SPACs are sector agnostic. It could apply to any sector. But clearly what investors and what would work best in a SPAC, or rather a de-SPAC scenario, are companies with a high growth potential, with a profile of high growth that, there is some track record, and obviously there is confidence moving forward. So when that is so-called what is ideal for investors in a de-SPAC situation, therefore it lends itself today in the real estate space. I think that we're looking at, again, the new economy plays, right? Whether, people talk about the new economy assets in the real estate world today, but obviously in a SPAC situation, it's not assets, it's operators, it's companies, right? It is not assets per se. So whether it is some new prop tech, whether it's some prop tech platform, some disruptor out there with a very strong, not just operating history, but potential for growth, that could be potential de-spac targets. But I think, and I'm sure Indran later on will share more insight, is, I think real estate traditionally, will they be the natural caption? May not be. Based on the profile that people like for a de-spac, they tend to end probably in technology, consumer tech, healthcare tech. Real estate, there could be some, but I'm not sure that it will be a large number.
Right. Yeah. Indran?
I'd agree with that. I think the benefit of the SPAC structure, the reason you have a sponsor and you pay a sponsor, the promote and all those things, is to help you navigate a slightly opaque valuation picture, right? In a traditional real estate business, valuations aren't particularly opaque. So paying away a promote doesn't quite sort of economically make sense for a target. That said, and just for some background, historically at least from the current boom of the SPAC market, real estate I think represents the smallest component of SPAC acquisition targets as well as de-SPAC scenarios. We're talking multiples away from the TMT and industrials and energy and consumer and all those things. That said, I think also prop tech has been perhaps a slightly slower part of that whole new economy tech ecosystem as well. But you are seeing new real estate oriented firms going out and raising SPACs as well today, more than they did before. Guys like CBRE, you mentioned Open Door before. Correct. That was Chamath's de-SPAC that company, right? Tishman, Crown, I think CBRE is doing their second SPAC. Sam Zell's doing one in the industrial space. There is room for it, and quite sensibly, a company that has spent its whole life in the real estate ecosystem is probably best able to assess what tech-oriented high-growth business is the most relevant for the real estate space. I think that's where it's relevant for real estate. If you're talking about an industrial asset in Jurong, probably not.
Okay. So it depends on the real estate company.
It depends on the real estate company.
Yin Mei, thoughts on applying SPACs to real estate?
So if you look at the examples in the market, and we've mentioned that Tishman Speyer, CBRE, Gore, a bunch of other real estate companies have backed SPACs. What have they de-SPACed into? Most of them are prop tech, right? So if you look, I think Gore went into commercial property security. Others went into mortgage lending, online platforms for rentals. And then I mentioned prop acquisition went into EVs. I think the closest into hard assets was Gore's second or third vehicle that de-SPACed into Sonder, which is a competitor to Airbnb. But unlike Airbnb, they actually own their units. So, there clearly are examples. You wouldn't think of sort of hard assets as being part of a de-SPAC target because, the market's fairly efficient in pricing what real estate is. It's probably in the areas where, there's high growth, right? There are certain categories of real estate where you would expect fairly high growth. And that, where it's not just, sort of stable rental income type things. So to the extent that it falls into that bucket, then potentially it could be part of the de-SPAC. I think that was the theory behind Sonder, given how Airbnb has performed. Yeah.
So basically, real estate assets that are a bit harder to value and with a lot of growth potential. Yeah, not your traditional brick and mortar stuff.
But bear in mind, there's still a lot of inefficiencies in the real estate world. So there is a lot of opportunity for
disruption.
For disruption. Some of it will be successful, some of it won't. But there is relevance. It just needs to be found.
Right. Yeah. Cool. We have talked a lot already, so let's get some questions from the audience. Maybe some questions from either the students or the finance professors in the room.
Yep, thank you, Professor Teo.
I never thought I'd get questions from a finance professor ever again in my
why
life. I
not?
put this behind me.
Or maybe you prefer a
I
question
put this
from a
behind me
student.
35 years ago.
Yep. We will now proceed to the Q&A segment. For our guests on site, please raise your hand if you have any questions. Our runners will pass you the mic. For guests attending virtually, you may submit your questions in the Q&A box at the bottom of your Zoom window. Thank you.
So while the people in the room make up their minds, we have actually a question from a finance professor that's online. Maybe Indran will want to take that. So this is my colleague Fu Fangjian, and he's asking, if many investors of a SPAC redeem their shares, then the SPAC may be short of the funds required to acquire the target at the price that they promised earlier. So what will happen in these situations?
You typically run a process called a private investment into public equity, like a PIPE process, like the bankers would go off there and raise a requisite amount of capital as part of the business combination, which will hope to, you'd have an estimate of what that redemption amount is going to be. Right. You make some assumptions around that and raise enough capital to cover it.
Is it bank's internal capital? Or?
No. It's from investors. So a PIPE process is what we were talking about earlier, where Elon Musk, go and talk to all the people, as a sponsor, I go talk to all the people I think relevant for my EV company, or the EV company that I'm buying, and I get them to give me additional capital on top of that original piece of capital that was raised at the SPAC IPO.
Okay.
Yeah.
Okay.
I mean, the PIPE process, and just to add some color to that, is, let's say, for example, they had raised 200 million at the SPAC IPO.
Right.
But they're going after a target at, let's say, an EV of $1 billion. So, and let's say the promoter says, look, I want to float out 50%, hypothetically. So that's 500 million. Obviously, he's still short.
Right.
He's only got 200 million in the bag. So in the PIPE process that Indran just described, he will then have to make an assessment. Look, do I go out and just raise the remaining 300, assuming none of the 200 people are ever going to redeem because they love the target?
Or you get a buffer, right?
Yes.
Okay.
So that's where they would typically run some scenarios and say, assuming 50% were to say, I want to redeem back my cash, then he would raise 100 to cover that 50% or 200 that is redeeming. On top of that, the 300 to make up that 500 that the sponsor or the target would want to get back.
Okay.
So then the PIPE would then be a total of 400, right? And typically a PIPE is there because, it's unlikely that the SPAC would be looking for a target at a 200 million valuation.
Sure.
Because plus the free share, the promo shares that they're getting, the dilution is too much for the company to absorb. So therefore, typically on average, you're talking about 4 or 5 times larger, or 6 times even or more, of what the SPAC has at the beginning, which is 200 in this case. So typically they will be going for anything 800 million, a billion, or even higher than that, so that the dilution for the promo shares is not too much to the company that is going for a de-spac, right? And the PIPE, therefore, is there to basically provide the additional capital required to complete the acquisition, plus factor in buffers in case there are investors who choose to redeem. Right. So, and that's why we say that really in a de-spac process, it's almost like an IPO process in terms of the rigor, but that PIPE is not public in that sense yet. Right? You're not going out like a full-on ATM offering, trying to make sure my books are covered.
Sure.
And you're able to do that together with the banks and get it covered before you go out.
These are private placements to institutional investors.
Correct.
Other thoughts? No? Any other questions from the people in the audience? Yes? One of the Masters in Applied Finance students.
Thank you, panelists, for taking out the time today. My name is Atisha. I'm a master's student at SMU. I wanted to ask, like, it feels as if SPACs are the perfect gold mine for both investors and targets. So do traditional IPOs still stand a chance against SPACs, or do you think they will lose their relevance over time? Thank you.
Very nice question. Thoughts from the panel?
Maybe, Yin Mei, you want to start first?
Yeah.
Make a change, ladies first.
Yeah, I don't think that traditional IPOs will lose their luster. I think, if you were an owner of a business and so you're confident you're ready to weather the book building process, you want to keep, your shareholding to yourself, right? If you're doing a de-spac, you're actually giving a portion of your company to the founders of the SPAC target. So question whether, an owner of a business is prepared to do that. So I don't think that the traditional IPO route will lose its luster for quite a lot of companies, to be very frank.
So is there an adverse selection issue? I mean, because if companies can do that, they will definitely do it the IPO way. But, only those that can't, potentially, you might want to do it through a de-spac.
No, not necessarily. I mean, there are, as we indicated, right, there are certain types of companies, the high growth ones, the ones which are a bit tougher to value. They're taking advantage of the market, the ability to negotiate the valuation in private to the price they want. And the de-spac route actually is beneficial to them, right? They get a good price, right? So it really depends on the de-spac target.
Different stroke for different folks.
Yeah.
Thoughts on the trends in the IPO market, whether these SPACs will dominate IPOs at some point? Indran and Ronald?
I actually don't think the threat to the IPO market is SPACs. I think the threat to the IPO market is how cumbersome the process has become globally. I think that's part of the reason why SPACs have gotten more interesting.
Right.
If you look at a prospectus today, when was the last time you guys opened an IPO prospectus? It's 1,500 pages. I guarantee you, nobody's reading it, by and large. Like there's a lot of legalese in there.
Except you and Yin Mei, right?
Yeah, except Yin Mei. And as the world continues to embrace technology and the various benefits that come from it, I can't help but think at some point somebody's going to come up with, why don't we just do this elsewhere in another simpler way?
Right.
SPACs are just one mechanism. Is it the thing that's going to kill the IPO market? No, but I think unless we all sort of figure out that 1,500-page prospectuses are not the best way to inform people about what they're buying commercially, I think there is threat to the traditional IPO market.
What's driving the length of that prospectus? Is it regulation or something else?
Yin Mei.
Yeah, I think, I have a specific view on this and sort of, in an era where you can buy cryptocurrency, you can buy any share, of your app in any market in the world, the conventional sort of 1,500 pages of prospectus, while good to have as an insurance policy for the issuer and the professionals, as Indran says, who's reading that, right? Having said that, though, there are, and the SPAC has been a reaction also to a faster route to listing. US, the direct listing route, i.e. which cuts out the bankers, has also been a reaction to the IPO, traditional IPO route. So you will continue to see that. The private market with just targets the institutional investors and sophisticated investors is very, very buoyant compared to the traditional IPO route in many countries. So there is, always going to be, with the advancement of technology and, sort of changes in the world, there is always going to be, a pushback against the traditional IPO route.
I actually think, I'm sure somebody here would have statistics about the private equity and venture capital route being more detrimental from an public markets perspective necessarily than SPACs. Like the capital that's gone into companies from that universe is probably a big part of where capital is coming from.
Depends on the timing, right? I mean, at some point they need to exit. No?
Yeah.
So time to market, and we've seen this a lot in a lot of transactions, right? Time to market is very, very critical. So if your process is going to take 9 months, 12 months, the guy is going to say, okay, let's just do a trade sale. Let's just find another alternative, right? So time to market, particularly now, is very critical.
I know SGX is having some issues with getting more public listings on the market. Ronald, any thoughts on how IPOs are on the defensive these days?
No, I think the fact that we're able to launch a SPAC successfully in Asia, to me, bodes well, because the SPAC product at the end of it, to the earlier question is it a threat to IPO? No, it's innovation, right? When we look at capital markets, we look at financial product, IPOs, it is an innovation in itself. I mean, even the SPAC product in itself has innovated. To be fair, we looked at it 10 years ago. I was part of that process. It was one of the classic cases where the regulators issued a consultation paper, it was closed, and there was no response for 10 years. On hindsight, that was clever. I never said no, I just sat on it. All right? If I said no, now I have to explain why I said no, and now I'm saying yes.
Sure.
So that aside, the point is, even the SPAC product had to innovate for it to work in the US market. And so to us, when we look at the capital markets, we have the REITs product, right, in Singapore that has worked tremendously well. But it had to be tweaked as well along the way. I mean, today, Mapletree, for example, one of the sponsors here, right, one of the masterful thing they did was to align their fees with unit holders payout, right? That was a definitive move, but then became mainstream and allowed the product to continue. I think, as in all capital markets, so just now Yin Mei stole the win, I was going to say direct listings, we have yet to see direct listings in Asia. Why not? Right? What are the rules that we will potentially have to look at this? Is someone going to come up with a feature in direct listing that is just going to make it super attractive? Just the way how SPACs took off, in the last 3-4 years in the US market. So the way I see the capital markets is that there is going to be innovation. We have to embrace it, right? And the fact that we were able to kind of be the first in Asia to do it bodes well, not just for us as an exchange, but I think for sponsors, professionals, investors here. It shows that we are prepared to rise up to the challenge and take on a new product, right? And if you think about it, our regulators being allowing for retail investors to come in for all the right reasons versus other jurisdictions where, well, it's only an institutional product.
Like Hong Kong, for instance.
Thank you, I didn't say that. But the point is, there is a balanced position that we are taking. That on one hand, we want to protect, but on the other hand, we want to encourage market activity, give people their decision-making powers. So all this, to me, bodes well, and there will be more new structures. So in the end, whether IPO becomes one route, let's see, right? Even in the real estate, back to the point here, real estate is reached the end point. Probably that may be one question that many people ask. Is that it? We've done all the world, we've done US, we've done Europe. What else is there? Well, product innovation. Maybe there is a place, we discussed this, at some point in Singapore where we do blind pool funds, blind pool REITs. Other jurisdictions have done it, right? So I think the excitement for us in Singapore is that we've got to keep innovating, and through this, we've shown that we will keep innovating.
Thanks. It's good to know that we are embracing innovation in the real capital raising space. Roger?
Hi. I think it's interesting you relate the specs to the stage where previously were institutions who were investing, but now retail are able to enter in a place where they can't. But I guess the difference is that institutions typically diversify across a large number of projects, and then some work and some don't. But for the retail investor, if you're marketing this as kind of a product that they should consider, probably they are not going to be able to diversify across hundreds of specs. So is it more like a lottery ticket, or some that will make it big? And then if this is how we are marketing it to retail investors, that could have some kind of problems with that sort of approach. So how are we going to kind of consider marketing it as an alternative asset class to retail? Any comments on that? Thanks.
I guess that was directed at Ronald.
Oh, yeah, sure. No,
Yes.
no, I think, I think when we work closely with MES, one of the very clear strategies we had in order to launch the SPAC product is investor education, right? Apart from the rules providing all the safeguards we talked about earlier on. So that is ongoing, and it will continue. In fact, we also did say that as the SPAC goes towards a de-SPAC, we want to have some neutral, independent research coverage around, what is the target? Is this something that they should be looking at? What sort of valuations should they be looking at? All these things are basically to help our retail investors have the knowledge, have the transparency to make a decision. But the fundamental premise is this: you've got to do your homework. It cannot be, I'm going to buy a 4D total, let's hope this is a winner, and tomorrow it's going to buy. You really have. What we can do as a platform, as regulators, is say, make all that information disclosure available, maximum dilution caps, it's all transparent. You know what's the potential dilution that's going to come. We have independent research reports that we made available for your de-SPAC targets, so you know what they are thinking. But at the end of the day, the responsibility will eventually still fall on retail investors to say, I need to make a decision, evaluate, is this the right choice for me? So I think that's to answer that question. But I think if I take a flip side to your question and look at what's happening in our market today, I mean, like some of you have mentioned, at a tick of an app, you can be buying to many, many global equities today, like this, right? And even through, well, whether it's robo funds or whatever you have, many of them are exposed to different sort of sectors as well. And some of them like to buy index. There are a lot of things under there that they may not fully even comprehend. Let's be very honest. It's just, let's look at the index return, let's look at the thematic, I'm going in. Now, I think that the information that will come out on the de-SPACs and our specs will even be more robust, because it's going to go to the individual company level. So I would say that the retail is going to get a whole lot of information, but we need them to actually do the homework. And one last thought is, to just be hypothetical about it. If we were to ask the question to anyone who is thinking, when is the best time for investor, including a retail investor, to participate in the SPAC? The SPAC IPO or after it's de-SPACed, right? Because that clearly is something that everybody's arguing, oh, you're exposing the retail to so much risk. Why do you allow that? But let me take the question in another angle and ask you this question. Think about it. If the assumption is the de-SPAC target is a lemon, okay? The SPAC investor came in at $5. They voted, let's buy the lemon, okay? And now we have agreed to buy the lemon. Hoo-ha, let's open the doors to retail investors because we've done the combination. So the retail investor comes in and says, okay, they've approved the lemon. I think it's a great lemon. Yep. I'm going to spend $5, or maybe it's gone up for that lemon. After it lists, or carousel listing, it starts to show what it really is, a lemon. The price starts going down. And the retail investor who only was allowed to come in at this stage is saying, hey, hold on, I bought it $5. Everybody approved this lemon. But it's now peeling out. It's falling to $2, becoming lemonade. And I can't go back to that, hey, I want back my money. Because it's an IPO. If a retail came in at a SPAC app and paid $5, and he sits there for 2 and said, that's a lemon at a de-SPAC, I do not agree to it. I want my money back. At that point of de-SPAC, he can choose to redeem his shares in cash. Maybe he gets back, I don't know, $5 at parity at best, or maybe some expenses less the interest. But he gets back $4.98 or $5. He's lost nothing. So my question is it really more beneficial to an investor or retail investor in this case to only come in after the business combination or before that? I'll leave that as a thought. But believe me, we have gone through extensive discussion around this. Some will take the view, no, when it's de-SPAC, give me the lemon, I'll figure out. But I will be taking full risk, because if it turns out to be lemonade, it's now worth $2. But if I allow an investor or retailer to come in at IPO of the SPAC, and at the de-SPAC, I think it's a lemon, I cash out. If I'm an institutional fund manager and I know there is a lemon, he'll be out at the de-SPAC. Guess who's left holding the lemon? The guys who come in at the de-SPAC. So I think if we actually sit down and think about all these dynamics, maybe what people have publicly said, we shouldn't let them come in at the start, may not always be the best route. But I leave you to your decisions.
Your answer reminds me of a saying, you know, when life gives you lemons, make lemonades. But not lemonades that cost $2. Other questions from people on the floor? Yes.
Hi, I'm Maria. I'm an exchange student from Louis in Italy. And SPACs have mainly focused on software, startup, so in real estate, on prop tech. And my question is, can a higher commitment on sustainability enhance the role of SPACs in hard assets?
So the role of sustainability in a SPAC?
Yeah, the role of sustainability, not only from an environmental point of view, but in a larger way.
Thank you. I think for SGX listed companies, we have enhanced our disclosure requirements. So there is a comprehensive ESG that we will already require from our listed entities. So if, let's say, it's a SPAC, and they finally de-SPAC, they would be required to comply, for example, with our ESG reporting. And obviously, we have also enhanced that given what's happening globally to ensure that they are climate assessment ready, right? And also be looking potentially down the road, are they going to be carbon zero? Where are they in that footpath, right? So I think that's the good thing, because once you de-SPAC and you're a listed company, at least on SGX, and I'm sure many other exchanges as well, this was going to be the requirement. But I'll just go a spin to your question. I think there are some sponsors who said, I want to do sponsor a SPAC that the target I'm going for are ESG, sustainably placed. And that certainly, obviously, will be very, very exciting for sustainability funds, fund managers who focus in that area.
Thanks. We have a question from Michael Falk. He's saying that SPACs can target high growth companies in early stages of growth. Is marketing such products to retail investors who have lower risk profiles compared to VCs and angel investors the right thing to do?
I think we spend a lot of time in Singapore, especially talking about the retail investor, and we need to protect him from commercial risk. And I appreciate that to be true, but at some point for the market to develop, people are going to have to start getting comfortable with the proposition that if I want to access growth, I need to be able to assess risk. You can't have it both ways, and that's just the nature of it. I don't think the bulk of a PIPE process I don't think a bulk of an IPO process is targeting that retail investor from an intent perspective. Retail components tend to be relatively small to begin with. But it does seem to be thematically constant that there's this mysterious force targeting retail investors with these shady products to get them to buy something, and by some weird twist of whatever power, I convince them to give me their money and they have no control over it. That's not the case. Everyone makes choices, right? And then you take responsibility for the choice. If there was fraud committed and someone came and lied to you about whatever it is they were doing, and things went horribly wrong based on those lies, that's fine. But everyone needs to take responsibility for what they buy. I think, that's...
No one's forcing you to buy lemons. Yin Mei?
I think as an industry, we've in fact, in recent times, we've debated this a lot, right? There is a choice, right? Either you don't access the retail market, you do it in the private space, and in fact, it's faster, it's quicker, the time to market a lot speedier. So if you were an issuer and you can access the private markets, you might choose to do that. The question, I suppose, is if you don't provide access to retail, to investments, is that good for the market, right? It straddles two extremes, right? There's a desire to protect completely to the extent that it's capital guaranteed and guaranteed to a return. And then there's the other extreme of risk that retail can't take. So I think where the industry is hopefully moving to is somewhere in the middle, right? There is a level and standard when you provide products to the market, the retail market, and the gatekeepers to that are the regulators. And then on the other hand, there's also education and personal accountability and responsibility over your investments. So in an ideal world, we would see the shift, right, of the population moving to a higher level of sophistication such that we don't default to the other extreme where, you know, it is capital guaranteed and the return is capital guaranteed, right? So it's somewhere in the middle, personal responsibility, industry responsibility.
Thanks, Yin Mei. I got an additional question from Fu Fangtian. He's addressing it specifically to Ronald, and he's saying, you know, does SGX allow SPAC investors to vote for the acquisition deal in a de-spac, but at the same time redeem their shares?
Yes.
And will this create some kind of weird incentives?
It is a question more of, look, if someone votes for it and if they potentially decide, look, I want to redeem that, on the face of it, it does look a bit contradictory, right? The question then is, why do we still allow it, right? The concern or the fear being that if we allow it, are they trying to push a combination across and then get off with that capital? I think for that theory to be true, for someone to be doing that so as to inflict harm to whoever, he is probably not making money out of it either. So let's think from, I'm not a lawyer, but what does he hope to get out of it? To vote it through, and then, oh, I'm taking it out, take out my cash. Because when he takes out cash, he's taking at parity or a slight loss. So let's put a very realistic cap. Why would someone do that? Because he's not making money out of it. So the theory that someone will do it because he wants to punish the next guy, penalize someone else, I find that hard to understand because he really makes no gain out of it. In fact, he is going to lose something out of it. So my only view of this is that the option is to provide that flexibility, that even after I voted, it is true, I think it's a good thing, I may choose to redeem cash if I want to, right? And I think that optionality will be provided. But again, whether or not the theory that someone is doing it so as to game it, so as to inflict damage, the truth of the matter is he's not going to get anything out of it. If nothing else, he'll get a loss. So we rather provide that flexibility and that benefit that you can choose to, well, redeem it if you want to, or stay on in the course, right? But that said, like I said, the other safeguards are there to ensure that it is not a lemon, there's enough disclosures out there. And one final thought, I know we're running out of time, is this. Regulations are here to provide disclosure, to try to ensure risks are mitigated. But regulations cannot safeguard against business failures or fraud. So as long as we look at regulations and say how they help us to mitigate risk, how they ensure governance, I think that's the balance that we have to take. Thanks.
Thanks, Ronald. I think you're running out of time, so maybe I just quickly summarize. So SPACs is a key innovation in the capital raising markets these days, and it's certainly beneficial from a company standpoint, from a de-spac target standpoint, because it gives them a higher level of certainty. It allows them to avoid the book building process, which would potentially induce a lot of uncertainty into the situation. And for investors, they need to be going for SPACs with credible sponsors that have domain expertise, and do their own due diligence. Anything else to add? Nope. No, thank you very much. I think that was a very insightful and wonderful discussion on SPACs. Thank you.
Thank you.
Thank you so much, panelists, for the wonderful discussion, and I think we've really learned a lot from the session here. So now, may I just invite the panelists to return to your seats, and Professor Teo, please. May I now invite Dean Bird on stage for the closing remarks. Dean Bird, please.
Thank you. Good afternoon, everyone. I am not a finance professor, Indran, but I thought this was really interesting and particularly fascinating that the question was, is a SPAC listing interesting for a real estate company? And the panel kind of said, probably not. That was kind of interesting. I know, when you talk about hard assets, but still an interesting answer. But we have come to the end of this third now annual Mapletree Real Estate Forum here, with the first two held back in 2019 and 2020. But this one, I believe we had almost 300 participants joining us, which is a bit of a record. So that's a very, very nice number. Really great to see such a strong sign-up today, better than the years before. And of course, I would like to extend my special thanks to our eminent speakers and panelists for sharing with us the trends of special purpose acquisition companies, or SPACs, something I must admit I didn't know much or even anything before today, so I learned a lot. So allow me to thank Ms Lock Yin Mei, Mr Ronald Tan, and Mr Indran Thana, our panelists, who have set aside their valuable time today to come and talk about this. And of course, let me also express my appreciation to Mapletree Investments. Since almost 10 years now, we've been on a journey, Mapletree Investments and SMU, since 2013, so almost 10 years, on a journey to help reshape the real estate industry through research and education. And of course, it all started back then with a gift from Mapletree Investments of $500,000 for the first Mapletree bursary that we established. But then in 2017, a further gift of $3 million was made to establish the Mapletree Real Estate program, which is still running very successfully today. And that really provides a vehicle for us to provide transformative education to our students and also providing opportunity for cutting-edge research in real estate. And then very recently, we got another gift of $2.5 million that enabled us to significantly expand the Mapletree Real Estate program here at SMU. And with this latest gift, we'll be able to do quite a few things over the next several years. First, we have created the Mapletree Scholarship, which we recently awarded to 2 undergraduate scholars. One of them, of course, is sitting right there, Donovan. And we've also created the Mapletree Postgraduate Scholarship, awarded to 3 scholars this year. And we created the Mapletree Research Fellow to support our research and curriculum development in the area. And as a result of all these gifts and investments in collaboration, we now have more than 1,000 students to date who have actually participated and taken the different modules that we're offering in our undergraduate real estate track since its inception. And we have, I think, currently 46 students specializing in the real estate track that we established with Mapletree support. So that's fantastic numbers. But of course, we also very recently launched a new postgraduate real estate track in our accredited Masters of Applied Finance program, which is a very exciting development as well. So I'd like to extend a very sincere thank you to the management and leadership of Mapletree Investments for your continued generosity towards SMU, and we look forward to deepening this relationship in the years ahead. Thank you so much.
Thank you, Dean Bird. Please remain on stage. We have prepared a token to show our appreciation to our panelists and moderator. May I invite Ms. Koh on stage to present the tokens. Ms. Koh, please. Firstly, may I invite our guest panelists, Mr. Tan, Ms. Lock, and Mr. Thana on stage, please. Maybe kindly present the token to Ms. Lock. Mr. Tan. And Mr. Thana. Now may the panelists gather and we will take a collective photo. Thank you. May the panelists return to your seats while Dean Bird and Ms. Cole, can you move to the center of stage, please? We would now like to present a token to our moderator, Professor Melvin Teo. May I invite Professor Teo on stage, please? Now let's have a group photo together. Thank you, Prof. Teo. Please return to your seat while Dean Bird and Ms. Ko, you may still remain on stage. Today's forum would not have been possible without the support of Dean Bird and the SMU team. May I invite Mr. Cheng to come on stage, please, to present a token of appreciation to Mr. Dean Bird. Everyone kindly remain on stage. May I also invite Prof. Song on stage for a group photo, please. Thank you, everyone. May I invite you to return to your seats while Dean Bird and Ms. Cole, please remain on stage still. Last but not least, may I invite members of the SMU Advisory Board for Mapletree Real Estate Program on stage for a group photo. Mr. Pok So Yong, Ms. Priyakini, and Mr. Wan, please. Thank you, everyone. Do return to your seats. Distinguished guests, ladies and gentlemen, we have now come to the very end of the third Mapletree Real Estate Forum here at SMU. Thank you all for taking your time to be here, and I wish you a very pleasant day ahead. Please take care and stay safe. Thank you.